Hi, welcome to our latest podcast. I'm Francesca and I head up the payroll department at Seavor Chartered. Today I have with us Graeme, our director and client manager, and Charlie, who's part of the accounts team and currently training towards his chartered qualification. Today we're going to discuss inheritance tax. I think in general it's a really hot topic at the moment. I think certainly I've heard a lot of conversations in our office at Seavor's. I've heard a lot of conversations out in the general, and I'm sure, Graeme, you've probably had a lot of conversations in meetings, etc.
Absolutely. I think the last 12 months I've probably had more conversations about inheritance tax than I have in my whole career. It's just so topical at the minute because of the changes that have been announced over the last 18 months, say, by the government. Really important things, and it's almost bringing more people potentially into the scope of inheritance tax. So it's something that people are concerned about.
Certainly. I think the best thing to start with is what is inheritance tax. Graeme, do you want to give us a big roundup on what it is and how it affects people?
So essentially, inheritance tax is payable by the estate of someone who's passed away, and it's based on what the value of that estate is as a general rule. So, what's an estate? It's what someone owns when they die. That could be their home. It could be rental properties. It could be the cash they've got in the bank, assets, cars. All that is valued. That forms the total value of their estate on which they would pay inheritance tax. And the standard rate of inheritance tax is 40% above certain thresholds. So it can be quite a significant tax if it's something you've not thought about. I think as well, a lot of people think inheritance tax is just something that wealthy people need to be concerned about. And potentially that's actually what used to be the case. But I don't think that is the case now. And I'd say, general average people should be just making sure that it's not something that's going to affect them or their loved ones later on when their time comes, and almost just to try and plan for it if they can.
Yeah, definitely. I think that's a really good point, that previously it was only wealthy people in general that actually had to consider it. And I think now the average working person who owns the home does have to consider it, whether it's for them, whether it's going to be for their children or even their parents. Yeah. I think in general it covers a lot more people now than they realise until they're having to pay it.
And the worst case scenario is you consider it, it doesn't impact on you, and then you can be reassured that there's no issues or nothing that, when your time comes, the people who are dealing with the estate, that they've got nothing to worry about.
Yeah. Perfect. I think, first of all, obviously, I think in general with inheritance tax, the property that someone owns is probably the main part in terms of value-wise. Charlie, do you want to go into like the nil rate bands and what they mean and what they are, and then also the residential nil rate bands?
So every person has a nil rate band, which is your kind of tax-free allowance. It's a bit similar to a personal allowance. It's £325,000. That is taxed at 0% for inheritance tax. So you get your £325,000, and additional reliefs can be your residence nil rate band, which is £175,000 on your main residence. So when you gift your main residence to a direct descendant, like your children, your grandchildren, then you get £175,000 of relief on that.
Well, I suppose if you passed away, then ultimately if your home's worth £175,000 or over, it's like an additional residential nil rate band you can use against your property,
on top of
the 325.
Yeah. So but then the downside to that is if your house isn't worth 175,000, it's maybe worth only 150, then you kind of lose that.
Yeah, absolutely.
So you don't get anything else on top of that. Yeah. Those two added together, you can get essentially £500,000 of relief there. Yeah. And then if you are a married person in a civil partnership, you also kind of get their £500,000 as well to essentially have a tax-free allowance of about £1 million.
Yeah, so I suppose if your circumstances fit into that, you're right, a husband and wife was, civil partners, ultimately they could have £1 million wealth between them, couldn't they?
Yeah, exactly.
Before their estate effectively would pay any inheritance tax. But there is, the detail to that, isn't there? So we're saying that £1 million, that includes two lots of 175,000.
Yep.
Yeah.
300. So that's 350,000. So if your home was worth less than 350,000, then actually you wouldn't get a full $1 million because that can only be used against your main residence, can't it?
Yeah. One bit to note as well, though, is that residence nil rate band, it only applies providing your estate is under 2 million. So for individuals who have a very large value estate, it can really start to trickle down. You lose £1 of your residence nil rate band for every £2 you're over that 2 million. So by the time your estate's over I think it's 2.35 million, you've got no residence, no rate band left.
Yeah, so then that disappears.
It goes, completely.
And that's important to know. It's only the residential nil rate band that tapers, not just the nil rate band.
Yeah, that's right. Yeah.
Which is important to know that they are separate.
Yeah. There's a lot of detail. It's a complex tax, inheritance tax, just in general anyway. Because even the bits that we were discussing prior to this, Charlie, that 175,000 as well, it only is available if that property is going to be left to a direct descendant. Ultimately, if you left it to your spouse anyway, all your wealth goes up. If you just left it all to your spouse, it goes up to your spouse, and they get them nil rate bands. But ultimately, if actually you didn't have a spouse or you didn't have a partner, that 175,000 would only apply if it was to a direct descendant. So an example of that could be, well, if you're living with a partner not married, and in your will you decided to leave your main residence to them, that ultimately could end up increasing your inheritance tax bill, because that 175,000 residential nil rate band isn't available.
No.
Yeah.
So even just certain ways of leaving assets and things can actually change what that inheritance tax bill could look like.
Certainly. I mean, I know we'll get into it a bit more, but it does all come down to planning in that aspect, doesn't it?
Definitely.
So I think another thing we'll discuss in terms of, obviously I know we mentioned the nil rate band and the residential nil rate band, but there's also something called potentially exempt transfers. Graeme, would you like to go into that a little bit?
Yeah, so a potentially exempt transfer, or a PET for short, is essentially if you're making a gift out of your estate. So if you make a gift out of your estate before you pass away, ultimately that's a potentially exempt transfer. And there's rules in and around that ultimately. So for example, if you gifted all your wealth away on your deathbed, that isn't a solution to avoid an inheritance tax, because that would be what's called a PET, a potentially exempt transfer. And ultimately for a gift to come fully outside your estate, it's got to have been made 7 years ago.
Yeah.
It can taper from that. I don't know if you want to go into a bit how the taper works in that, Charlie.
So if you maybe survive only 3 years, maybe 3 or 4 years, it starts to go down by 8% every single year. So after 3 years, it drops to about 32%, and after 7 years, it's completely exempt.
So that's the inheritance tax rate, isn't it?
Yeah,
so it would
that
be.
You pay.
So like if you make a gift, 0 to 3 years, if you passed away in that time from the gift, it just comes back into your estate for the inheritance tax calculation, and you're paying a full 40% on it.
Yeah.
If you died between years 3 and 4 after the gift, that rate comes from 40% down to 32% on that gift.
So you're still paying it.
So you're still paying it
at
at
a
lower rates.
percentage.
Yeah.
And obviously it keeps going again to the 7. And then once you've hit 7 years, that's it. It's
The gift's
outside the
your estate
estate,
and no inheritance tax.
you've done good planning.
Yeah. No, ultimately that's what, I have heard inheritance tax described as the only voluntary tax.
Yes.
I don't know if that's quite the case, because sometimes, there's other taxes that would come into it. But ultimately, if with planning, you give and live, the longer you live, gift early, ultimately you can get your estate down to a point potentially where there's no inheritance tax payable. Yep.
Yeah. And so that's one of them things, isn't it? You're saying like live longer and gift early. It really does come down to the earlier you gift, get rid of the asset, provide it to your family and friends, etc., that you want to outlive the 7 years, and then you've done the job of having to avoid a tax.
A big part of the conversations we have as well, because nobody wants their estate to pay inheritance tax. You've paid tax to earn the money anyway, and then to find that you're paying another tax at the end, it just feels very unfair, but that's the way it works. But also as well, you've worked very hard to accumulate that wealth, and then just to be giving it away, you still want to have a standard of living and a lifestyle and not be dependent on other people. So there's a balance to be had as well.
Certainly. I mean, and it's probably a really difficult conversation if I'm sat there with someone and they've maybe got parents that are 60 and they're having to consider that, but then you're telling someone whose parents are 60 that actually they need to give away all the money.
Yeah.
Because
or they've got a problem.
It can be a difficult conversation. And then these parents who are 60 could live another 25 years.
Yeah, absolutely. And
they've been given away money for 25 years.
Yeah, that has to come into it.
Yeah,
it does.
Yeah.
So but then again, something could happen, touch wood, but something could happen tomorrow.
Yeah.
And
I think the important thing is just that it is considered, and them conversations as a parent, you do have them with your family, and ultimately you've earned it. It's your decision to make, but have the conversation. At least then there's no and ahhing and any awkwardness, because you've decided what is right for you.
Yeah.
But also you have an understanding of, yes, you maybe worked hard, you want to keep hold of it, but it would be such a waste as well to be paying 40% over potentially of a large part of your wealth for no reason at all, just because you haven't had the conversation.
Yeah, you either haven't had the conversation or you've worked really hard for a lot of your life and you're trying to enjoy it and then something happens.
Yeah,
I think the bit that stings even more is now that from April 2027, they've also brought pensions and pension pots into this scope.
Yeah,
so I feel like, you're working all your life, you're putting these contributions into your pension and you don't even get to claim it, or you don't even get the full amount.
I suppose pensions used to be a big thing for tax efficiency and planning anyway, and almost there was never a bad thing about putting money into your pension to prepare for your retirement and live well in your retirement. And that is just such a good thing that you anybody should want to do if they can afford it. But almost now there comes a level where it's like, well, I don't want to save too much in my pension, because if I oversave in my pension and I can't actually use it in my retirement, a lot of that could be exposed to inheritance tax with very little manoeuvre currently and what you can do with it. So it's changed that no-brainer tax planning, sensible thing to do. Now it needs a bit more thought as well on planning for the future.
Yeah, certainly. I think that is going to be a bit of a blow to a lot of people come April 2027 when they're having to consider pension, because some people that maybe max out the amount they can put in their pension every year thinking, I'll enjoy that, save some tax, enjoy it when I come to take it, and then it's took off them at 40%. They've basically lost nearly half of it. Yeah,
and there's more technical stuff
there is.
Even to that. For example, if you leave a pension to a family member after you've passed away and that's paid inheritance tax on it because you were over the relevant thresholds, it's still in the pension wrapper. And what that means is when whoever then comes to take that money out or enjoy it, they're going to pay their income tax at their marginal rate. Yeah. So it's had inheritance tax payable at it of 40% potentially. And then now it's what's left in a pension wrapper for the next person to take out, but have to pay 20, 40 or 45%. Yeah. So it's, it really does need some thought.
Yeah, definitely. I mean, we could obviously go into it more, but paying up to 80, 85% on a pension when someone's worked really hard.
Yeah, it's not good.
No
it's not.
It feels really unfair. And we were having this conversation that, like, say, if you die before this April 2027, it's more beneficial. You don't want to have to think like that, but you can save a lot of money.
Well, we were doing some planning for a client recently, weren't we, Charlie? And it was kind of depressing to say that if such and such's parent died before April, they'd pay £500,000 less inheritance tax than if they die in April or later.
Yeah.
And that it just feels like a bit of a cliff edge, that really, doesn't it? And it shouldn't be that.
You want them to live as long as possible, don't you? You don't want to.
Yeah.
But for tax purposes, in that case,
it's horrendous, really, when you're having that conversation that you've got 12 months, or you'll have to pay £500,000 more. Yeah, it's like,
yeah.
Following on from that, I think we'll talk a little bit about capital gains tax. I know it's obviously not inheritance tax, and it is something different, but they do come hand in hand a little bit.
Yeah. So I suppose we've talked there about gifting assets, and ultimately, if your estate, let's say you had £100,000 in your bank account, that's quite easy to gift away. You gift it away, and if you live over 7 years, that's now fully outside your estate, and no inheritance tax is payable. And people think, well, that's really easy, then I'll just gift everything away. But unfortunately, it's not quite as easy as that, because some assets, if you gift them, could result in a capital gains tax bill. The most obvious one is property.
Yeah.
So, for example, you could have had a rental property that forms part of your estate, bought it 20 years ago, but in that 20 years, it's going to potentially have increased significantly in value. Let's say you bought it for £100,000 20 years ago, and now it's worth £500,000. If you sold that, you would pay capital gains tax on the gain. And likewise, if you gift it, whoever you gift it to, whether it's a family member, a third party, it doesn't matter. You're going to pay capital gains tax on the market value.
Yep.
So you have to consider I want to gift to avoid inheritance tax, but then we need to understand the gifting problem of what immediate capital gains tax bill it could produce. And then as well, if you've gifted it, you've still got that 7-year clock. And if you passed away within the 7 years, the value comes back into your estate.
Yeah.
So you could end up paying 2 taxes. So it really does need some thought, some planning. And yes, you are going to have to make a couple of calls on some things, but understanding the risks in and around them.
Yeah, because you might be saving a little bit of inheritance tax further down the line, but now you've got this big capital gains tax bill that you've got to foot.
Yeah, definitely.
And if you've gifted it, not necessarily even the cash to pay it.
Yeah. certainly if you've all your assets is in physical assets and not cash asset,
not liquid.
then you're going to have to find the cash asset to pay that tax.
Yeah.
Certainly. Yeah. So following on from gifting homes, Charlie, do you want to go on the whole gift of home and gifts with reservation in terms of most people would say I'll gift my family home, but what complication does that come with it and what do they need to consider?
Yeah. So say you are thinking about your inheritance tax and you're doing a bit of planning and you decide that you're going to give away your current home, say you give it to your children, you cannot continue to live in your home without paying like market rent. For example, you cannot benefit from this asset after giving it away.
Yeah.
So either
because then you haven't really truly given it
no,
away.
exactly.
Because you're still benefiting from it.
Yeah. So either you've got a few options. The most obvious one is to pay rent on to live in that house, and I mean you've given away your house, and then you have to pay rent to live in it.
Yeah.
The other one is move out completely.
Yeah.
So it's quite a tricky one in that sense. You can't ever benefit from.
Yeah. And when we say rent as well, it's got to be a market rent. So effectively, you've lost the benefit of that house because you're just renting in it. You know, you don't own it anymore. You're not living in it for, and you can't live in it for free. Otherwise, that's a gift with a reservation.
Exactly.
But if you pay a market rent, then ultimately that's what you would do if it was another property. So that means it could still come out of your estate after the 7 years. So that's how that would work with the market rent aspect of it. But you know, you're reducing your inheritance tax bill by gifting away, and then not only that, you've got to pay rent
to live in your own. Yeah, so you have to pay to live in your own house, and if you're giving it to your children.
Yeah, and you can't do a thing where all of a sudden children give you the money almost to pay you the rent.
Yeah.
You know, HMRC are wise to these sort of circle things, and they would, you know, ultimately they would look at the substance of the transaction, and if the substance is you're now not paying rent out of your income or savings, then you're not truly renting and you haven't truly gifted the property.
Yeah, so again, it's one of them things, it can be done with the right actions put in place, but you still leave yourself open. The HMRC can still
You've got to be diligent.
Look at that. You need to be really diligent, have proper documents in place. You know, with the market value, you'd probably have to reevaluate that every year before you opening yourself up to then that further inspection.
Yeah. Well, if it's market rent year 1, that doesn't mean it's going to be market rent in year 4.
No,
I mean,
if it's not, it can come back into the estate.
Yeah, definitely. I know we've certainly touched on in general that inflation. I know going back a little bit, how we said the nil rate band's 325,000.
Yeah.
I know, Charlie, I don't know if you mentioned it, but they've been frozen since 2009.
2009, and they are frozen until 2031.
Yeah.
What approximately would that be now then? So just think it was 325,000, that threshold in 2009. We're in 2026 now.
Yeah.
And the threshold is still 325,000.
Yeah.
Well, if we all think about how the value of money and assets and property have gone up in value, well, no wonder more people inheritance taxes becoming a topic for them that they have to be.
Inflation's gone up by 70% odd. So I was thinking about it before, what you'd be paying now if the nil rate band was in line with inflation, you'd be looking at about £500,000 for nil rate band. But since it's frozen, it's going to continue to go up. It's going to be even
more people potentially into a bracket where they're paying inheritance tax.
Yeah, I mean, that certainly, to be fair, falls in line with, I did a quick research, and that in 2009, the average detached house in northwest England was 220,000, but in 2006, it's 430,000. So
these house prices are going up.
But the rates, average houses are going up. Yeah.
The rates aren't changing at all.
Yeah. And I think another thing to note there is that back in 2009, your average detached house fell under the residential rate band, but obviously it's now well over. So it's just another thing to consider, isn't it?
Yeah.
Definitely.
I think obviously we've discussed a lot on family wealth planning, but there's also developments in business and agricultural property reliefs. Graeme, do you want to go into both of them for us?
Yeah, so it used to be that if you had a agricultural business, a farm, and any a business as well, that ultimately you'd get 100% relief from inheritance tax. That would mean ultimately you could leave a business or an agricultural asset or business or agricultural business or farm to your children, and there'd be no inheritance tax payable on that, irrespective of the value.
Yeah,
but then. In October 24, I believe it was, they said, well, actually, we're going to reduce that. So actually the first £1 million of that value of that farm or business asset will get 100% inheritance tax relief. After that, you'll only get 50%. So basically you're paying tax at an effective rate of 20%.
Yeah.
There was a hell of a lot of backlash from it.
Yeah.
Obviously disastrous for farmers. The government's did a bit of a U-turn on it, and I'm saying only a part U-turn on it because they've increased that now to 2.5 million per person. So if you had a husband and wife who owned a farm, ultimately now that could potentially be worth £5 million before inheritance tax would be payable.
Yeah.
But it's still, in my view, a massive problem for farms and business owners, because especially if we take farmers as the example, they've potentially got a high value wealth, but it's in assets. They don't have cash cash there available to pay any inheritance tax, and they need every acre of land they've got to farm for that farm to work as it does. But if now their farm's worth £6 million, they're paying inheritance tax at effective rate of 20% on £1 million, and they've got to find that money.
Yep.
And the money, where's it coming
it's
from?
Stuck in the asset.
And it's almost, the farm's going to potentially have to sell land to fund it, or they're going to have another, it's almost like getting a bank loan for the next 10 years to be paying this inheritance tax, and it just doesn't feel quite right again.
Doesn't
or
feel quite fair either.
But and I know the statistics out there, they say, well, actually it won't affect that many farms and this, that and the other. But if we think of the land prices down south, I think there'll be a significant amount of farms that'll be affected.
Yeah.
And especially with those kinds of things that, they're very, you can't liquidate the assets quick enough. You cannot just sell a farm overnight to pay that inheritance tax bill.
And even if they're thinking, well, we'll just sell a little bit. Farms normally, they need every single acre of land that they've got. Otherwise, they've got an increased cost.
Yeah.
They're either going to rent more land, or they've got to buy product in, or whatever. And, essentially the people who made the rules, I don't think they own or run farms and understand how they work.
No. I mean, certainly, obviously, living in Cumbria, we'll see all the farms out and about. I think every street you go down almost, or every area of Carlisle, certainly, that you go in, there is a farm. So obviously it does take up a lot of space, and land obviously does cost a lot of money. So it soon hits that 2.5 million.
It was, I suppose it was farmers who really led the push to get that increase, but it does affect your family business owner just the same. So, you could have had a really successful family business employing a significant number of people, and that business now was valued at £10 million or whatever. Doesn't mean it's got the cash to pay the inheritance tax on the 5 million. So what do? Do they sell part of the business? Do they sell the business off entirely? Do they sell a factory that they needed just to cover their inheritance tax bill? It just, I understand almost off the face of it why they think, well, generational wealth, but at the same time, do we really want to ruin or stop commerce farms when actually they are delivering a lot of benefit to the country?
And going back to that as well, when you say they're going to have to sell bits off, when they sell bits off, they're going to have to pay capital gains tax on those. So you can't avoid it at all. There's no way around it.
Yeah, certainly. So following on from the whole wealth planning and developments in business and agriculture property reliefs, is there any strategic planning that can be done with inheritance tax or capital gains tax, etc.?
Yeah, so I suppose when we're doing it, often with inheritance tax, some of it can be boring planning, give, live, look at the basic things, but often there can be some clever things that you could do as well, whether that's converting non-business assets to business assets to utilise the business property relief thresholds. So that can be things that you can look to do.
Putting excess cash, buying assets in the business, because with the cash is taxed at 100%. It's all in the estate, but you buy assets in the trading business and you can essentially get that business property relief.
So for example of that would be you've got £100,000 in the bank, which if you passed away, that just forms part of your estate. You've got to pay inheritance tax on it.
Yep.
If you gifted that away, you've got to survive 7 years.
Yep.
Unfortunately, if some people start planning a little bit too late, potentially they don't think that 7 years, they're going to last 7 years, there'll be inheritance tax payable. Yeah. Well, for example, investing into business assets, that could come out your estate within 2 years, or at least get the business property relief in 2 years, which so it's almost effectively getting the planning shortening that 7 years to 2 years by just considering it and thinking of the planning. And
I'm presuming 2 years comes from that's how long you have to have the asset or a business to get the agriculture property relief.
Absolutely. Now, if you already had a business, husband and wife, that's worth over £5 million, them options aren't going to be available to you. But this is where you've got to, each specific circumstance, you've got to look at it and see what opportunities there are available to you. There also is things like trusts that you can consider, really complex. And often people think, oh, that's just the solution. I want to set up a trust that'll stop inheritance tax. Unfortunately, it just it just doesn't work like that. And a lot of the levers you've got to try and help with your planning off, you know, even if you're involved in a trust there, could apply to that as well.
Yeah, certainly. I think as we wrap it up a little bit, do you each want to give me a key takeaway from today?
Do you want to go first, Charlie?
Yeah. So like we said at the start, it's one of those considerations for everybody nowadays. Like
Not just the wealthy.
Exactly. It was originally just something that only wealthier people would think about. But now that we're talking about the nil rate band being frozen and house prices are going up, it can just be your average person who has a decent pension, has a valuable home, and just has a good bit of money. Then it can affect them, like even if they didn't originally think it would.
Yeah.
So they can get caught out. Like they'll get maybe nasty surprises when somebody like that dies. And if there's no planning put in place, it's just worst case scenario.
Yeah. And I suppose my key takeaway is just, you know, do consider your circumstances early. At least then if there is something to worry about, you can try and do something about it.
Perfect. I think my key consideration is that to consider all taxes together, although our podcast today is on inheritance tax, that we also have touched on the capital gains tax side of it and how other things can come into it, and also to keep your plans under review consistently.
Yeah.
I know in our
Rules
industry,
change.
we see things changing all the time. We see decisions made, we see them go back on it. Certainly, I know it's irrelevant, but the double cab pickup always springs to mind on plans changing back and forward
U-turns.
and backward, and U-turns happening, and things can change in the space of a year, in the space of 6 months. So definitely,
Or the double cab pickup in the space of 24 hours.
I think that's my main one.
Which is incredible.
But yeah, so thank you both for coming in today. It was really good to hear your thoughts and your opinions and your expertise on the situation. As always, if anyone would like to contact the office on 01228 904 904, someone in the team will be there to help.